Hey everyone, Farhan here. So today you will solve question 4 from 2015 past exam. In this question, firstly you will record the balance sheet adjustments in the journal, then you will prepare the current liability section of the balance sheet, and then we'll discuss three features for the accrual basis accounting system. So this question comes with many complications, so make sure to focus and follow through the entire content for an excellent understanding. So with that being said, let's get started. GB Jeans prepares reports every 3 months. All stock is marked up by 50% on cost. So we're working with the business which reports 4 times in a given year. In a year, we have 12 months. And this business reports every 3 months or every quarter. So this means in a year, we have 4 quarters, which also means that this business reports 4 times. At the end of month 3, at the end of month 6, at the end of month 9, and at the end of month 12. All right, so we're given the pre-adjustment trial balance extract as of 30 April 2015, and then you are given some additional information. And as you know, the first requirement is to do the journal entries. Now, on the right-hand side of the screen, you can get to see all the workings. So firstly, let's discuss the purpose of preparing the pre-adjustment trial balance. Now, the pre-adjustment trial balance is prepared to ensure that all the debit entries equal all the credit entries. This is mainly done to make sure that the double entry bookkeeping process that we have done so far, which is starting with the recording of transactions in the journal and then posting them to the ledgers and balancing the ledgers, have all of this been done accurately or not? If we find any errors, we need to fix those errors prior to the preparation of financial statements so we can make better decisions with more accurate profit and asset, liabilities, and equity figures. So let's look into the first additional information now. So drawings of $1,200 were incorrectly posted to the wages account. Now, if we want to fix this, we have to reduce wages because we had overstated wages when we recorded this earlier. So now that we are fixing this, we have to reduce wages. Now, wages is an expense account by default, and all expenses, when they increase, we debit them. Therefore, since wages, which is an expense, is now being reduced, we have to credit it, which is the opposite of debit. Then we have to increase the drawings because, in fact, we actually had drawings, but we ended up recording that as wages. So now that we are fixing it, we have to increase the drawings. And when drawings increase, we debit them. So the correct journal entry is to debit the drawings and to credit the wages by $1,200. Now, if you check the journal entry space that we have been given, you can see we are given multiple columns for general ledger and subsidiary ledger. Now, where should this transaction be recorded for drawings and wages that we are fixing? So first, understand the difference between the general ledger and the subsidiary ledger. Now, the general ledger records all the transactions relevant to assets, liabilities, equity, expenses, and income. And subsidiary ledger specifically has records for individual customer and suppliers that we have. For example, if we were to look into accounts receivable and accounts payable, who are the credit customers and the credit suppliers of the business, these are what we will be recording in the general ledger, which is a summary of all the transactions that we have done with all the customers and all the suppliers of the business. But if you were to look into subsidiary ledger specifically, you would have accounts for different customers, such as customer 1, customer 2, customer 3, and all of these 3 credit customers can make the total of the accounts receivable, which we are reporting within the general ledger. The same thing applies to accounts payable, which is a summary of all the transactions conducted with all the suppliers of the business, which is what we're reporting within the general ledger. But if you were to look into the subsidiary ledger, you would have separate records of transactions done with credit supplier 1, credit supplier 2, and credit supplier 3. So this is the main difference between general ledger and subsidiary ledger. So by now, we're 100% confident that the subsidiary ledger, in this case, only has the individual records for each customer and each supplier that the business has. Therefore, since we are recording drawings and wages, it doesn't really fit into this category of accounts receivable and accounts payable Therefore, we do not have to record them in the subsidiary ledger, but rather in the general ledger. So that is what we have done here. So at the end of 30 April 2015, we are debiting drawings by 1,200 and we're crediting wages by 1,200. By the way, let's double check if the reporting period is 30 April 2015, and yes, that is it. And therefore, this is correct. Before we move to the next information, I also want to discuss something else. So when we debit drawings, what does that really mean? So we are debiting drawings. So drawings reflect a reduction in owner's capital or owner's equity. Capital that is invested within the business is always credited, which means when capital increases, we credit them. So therefore, if capital decreases, we should debit them. And drawings, which is essentially representing the reduction in owner's capital, will therefore be debited. So that's the logic here. So debit drawings by 1,200 and credit wages by 1,200. So let's move to the second additional information that we have. Now, before we start the second additional information, let's look into the terminologies for a few of the items that are given within the pre-adjustment trial balance, because this question is from the all curriculum, right? So you can start with the creditors control, which is what now we refer to as accounts payable, or the credit suppliers of the business. These are the people from whom the business purchases inventory on credit. And then we have also got prepaid sales revenue, which is now what we refer to as unearned sales revenue in the new study design. All right, so let's read the second additional information. Prepaid sales revenue, which is also known as unearned sales revenue of $2,700 has now been earned. All right, so what is unearned sales revenue? So unearned sales revenue refers to a current liability. All right, so this means that we have collected the cash in advance from our customer, but we are yet to deliver our product or the service to our customers. Therefore, from our perspective as a business, we haven't actually earned this revenue, right? So we have only got the cash in advance from the customer, and we are yet to fulfill our promises with the product or the service that we're offering. Right? So given that unearned sales revenue by default is a current liability account, it must be credited when it increases. Based on the additional information that we are given, it explicitly mentions that $2,700 of this unearned sales revenue has now been earned. So if this has been earned in the financial statements, we can recognize this as sales revenue that has been earned and include this as part of our profit calculations. But this $2,700 is now also reducing the current liability. Therefore, when we are reducing the current liability, we have to debit it because liabilities, as we know by default, are credited. So when they increase, we credit them. But now that they're decreasing, we have to debit them. So that is why we debit unearned sales revenue by $2,700 to reflect that reduction in the current liability that we have previously recorded. And then we credit the sales or the revenue by $2,700 to reflect that we have earned this $2,700 worth of revenue, and this can now be added as part of the profit calculation in the income statement. All right, so I'll just make a note here as well. So within the pre-adjusted trial balance, so prepaid sales revenue was originally $3,500 within the credit column because it was a current liability, but now you have to subtract $2,700 and add $2,700 to the sales instead. All right, so one is referring to a reduction in current liability and the other is referring to an increase in overall sales or revenue. All right, so let's move to the third additional information now. The vehicle is depreciated at a rate of 20% per annum using the reducing balance method. All right, so using the reducing balance method, if you are to calculate depreciation, we first need to find the carrying amount. So how do we find the carrying amount? So the carrying amount is equal to the cost minus the total depreciation, which is also known as the accumulated depreciation. The asset that we are working with in this case is the vehicle. Now, the vehicle at cost is what you will get from the debit column of the pre-adjustment trial balance. As you can see here, which is $35,000 reported within the debit column. All right. Now, this is the cost price for the vehicle, the original price that we had paid to purchase this vehicle when we had acquired it. Then the total depreciation, which is the cumulative depreciation of vehicle, and that is 15,200 reported within the credit column. The reason it is reported within the credit column is because it is a contra asset account, which is there to record the reduction for economic benefits that has been consumed from the vehicle so far. All right. So assets by default are debited, but if you have a contra asset account, it has to be credited by default, because since that account is basically there to record all the economic benefits that we have consumed by utilizing the vehicle within the business for the purpose of generating revenue. All right. So now that you can find the carrying amount, $35,000 in cost minus the $15,200 in total depreciation, we get $19,800 in carrying amount. So if you want to find the depreciation, we are actually calculating the annual depreciation, because the 20% that we are given is an annualized rate, which the question specifically mentions. So depreciation per annum is percentage multiplied with carrying amount. And the reason this is the carrying amount is because we are using the reducing balance method, right? So 20% multiplied by $90,800 in the carrying amount, which we had derived earlier, and that gives us annual depreciation of $3,960. But hang on, we need to be careful with something else. Always check the reporting frequency prior to doing the balance sheet adjustments. And the very first line of the question says, the reporting frequency is every 3 months, which is every quarter, all right? Excuse me. So if the reporting period is 3 months and we are given the annual depreciation, which is for 12 months, then how do we convert this 12-month value of 3,960 into a 3-month value? So in a year, we have 4 quarters, and every quarter makes up 3 months, right? So that means if this is an annualized value, therefore to convert it into a quarterly amount, all you have to do is divide by 4, given that within a year we have 4 quarters, all right? So 3,960 divided by 4, which is equal $990. Now, every time you're recording depreciation in the journal, it's always the same entry, but you only need to be specific in terms of the asset that is involved. So you debit the depreciation expense, in this case, by $990, but you must write depreciation of vehicles to be specific, all right? Because if you do not write the specific asset in this case, you'll lose marks. So depreciation of vehicle debit $990, and credit is the cumulative depreciation of vehicle $990. And again, we're doing this within the general ledger because we don't have any accounts receivable or any accounts payable involved in this case, all right? Okay, so let's move to the fourth information that we have, and this is the most complicated one out of everything. So we're going to break the fourth additional information in multiple steps. Right, so on 30 April 2015, the owner traded in the vehicle for $12,500. So this is talking about the old vehicle, all right? The depreciation, which we had just calculated, right, of $990, the old vehicle, we have disposed it on 30 April, and we have disposed it for $12,500, right? We have also purchased a new vehicle costing $49,500, and that is including GST, okay, from Kern Motors, and the source document is invoice 344. All right, so we will record all the journal entries that comes with this additional information, starting with purchase of new vehicle, all right? Okay, first of all, we know that the cost, including GST, is $49,500. How do we go from GST including price to GST excluding price? So you just divide with 1.1. And if I want to find the cost excluding GST in this case, it's 49,500 divided by 1.1, and that's 45,000. The reason we're dividing with 1.1 is because mathematically, this makes sense because the GST rate is 10%. So if we were to start from 45,000 being the cost excluding GST, and you want to add the GST on top of this cost, it would be 10% multiplied with 45,000, which would be 4,500 as the GST, right? So the total cost, including GST, in that case would have been 49,500. So using algebra, if you just want to find the cost excluding GST, you just simply take the cost including GST and then divide with 1.1. And this is something you can do every time if you are converting from including GST value to excluding GST values. Okay, so the GST is therefore 4,500 and the cost price excluding GST is $45,000. So the fact that we have purchased a new vehicle, how do we journalize this? Given that we have bought a new vehicle, it is increasing the assets of the business. So when the assets of the business go up or when they increase, we debit them. So we are debiting vehicle by $45,000. Obviously, it needs to be the cost price only, excluding GST. Because when we debit vehicle by $45,000, this means that in the balance sheet, I'm going to record this value of $45,000 within the non-current asset section for the vehicles that we have purchased. At the same time, we have GST clearing of 4,500. Now, why am I debiting this? All right. GST clearing is a liability account by default, right? Which means every time I'm collecting GST from my customers, my obligation with the ATO goes up. And when I'm collecting GST from customers, I have to credit them within the GST clearing account, right? Now, when you are paying for GST, which is mostly for expenses, such as rent, such as also the purchase of non-current assets, which in this case is the vehicle, that should reduce the obligation that you have with the ATO, right? So within the GST clearing account, which is a liability account by default, any GST that I'm paying to someone would be recorded on the debit side so that I can reduce my obligation before I can make the final settlement with the ATO later, right? So therefore, any GST that you're paying should reduce the liability. So that's why if liability goes down, we debit them, right? So we debit GST clearing by 4,500. Altogether, the total value of transactions that we have done with Kern Motors is $49,500, and that is what we owe them, all right? So that is what we owe them. And the reason we know we owe them is because it says invoice. It doesn't say receipt. Like we haven't paid any cash or we haven't done any dealings for cash yet. We just purchased something with a promise to pay this dealer later. And you need to write other payables and you need to be specific, Kern Motors. You can also write sundry creditors, but I believe this has changed based on the new curriculum and it doesn't really make a difference. But the reason we are crediting other payables and specifically Kern Motors by 49,500 is because this is a current liability. This is an obligation for the business, all right? So when the liability goes up, which is referring to the other payables or the sundry creditors in this case, we have to credit them, right? So that is why we are crediting other payables, Kern Motors by 49,500. So these are the 3 lines that are applicable for the journal entries for the purchase of the new vehicle. I'm not going to record them here separately. You can record them, but these 3 lines must go here in the main exam. Okay. Next, we know we have got rid of the old vehicle that we had, all right? And that old vehicle was not sold for cash, but rather it was used as a trade-in when we were purchasing the new vehicle. Okay, so first of all, there are multiple steps to doing this. So the first thing we need to do is write off the cost of the old vehicle. So how much is the cost of the old vehicle? So the pre-adjustment trial balance didn't have the new vehicle's purchase value included, right? That is why it's a pre-adjustment prior to adjustments. So the cost of the old vehicle was 35,000 in this case. So when you are getting rid of the old vehicle from the books, you have to remove it. And in that case, you have to reduce the assets. So when assets go down, what do? We credit them. So we are crediting vehicle by $35,000. At the same time, why are we getting rid of this vehicle? Because we are disposing it. Therefore, the debit side will be disposal of vehicle by $35,000. So every time you are disposing an asset, you need to first start by writing off the cost. And you can memorize this and you're going to get it 100% correct every time. So we debit the disposal of vehicle and then we credit the vehicle to reflect that reduction in the cost price of the vehicle that we have in the books. And that is 35,000, which is what we have picked from the pre-adjustment trial balance. That is the cost value of the old vehicle. Okay. The next thing you need to write off is the total depreciation. When you want to write off the total depreciation, what we are doing is we are removing all the depreciation that we had recorded earlier in the books for the old vehicle. So we know that accumulated depreciation of vehicle or accumulated depreciation of any non-current asset out there is a contra asset account, which is always credited. And the logic that we had discussed earlier is because this account is credited by default because this account records the reduction in the economic benefits that we have consumed for the relevant asset that we're talking about, which in this case is the vehicle. So given that we now need to remove this accumulated depreciation of the from the books, which by default is credited, which is also what you can see here from the pre-adjustment trial balance, now that we have to remove it, we have to debit it, which is the opposite, okay? So we are debiting accumulated depreciation of vehicle, and you are going to credit disposal of vehicle, okay? So what is the amount? Now the amount needs to be calculated. So total depreciation of the old vehicle is $15,200, which is what we're getting from the pre-adjustment trial balance, plus the additional $990 that we had derived ourselves just a while ago, if you remember. So altogether, the total depreciation is $16,190, okay? So this is the entire amount that we need to write on. So when you are debiting accumulated depreciation of vehicle, you debit it by $16,190, and then you credit disposal of vehicle by $16,190. Right. So here we have 4 extra lines, so make sure to include all of this. So far we have 7 entries, including the purchase, which has 3 entries. Okay, all right. Now, what about the disposal receipts? Now, the trade-in allowance for this old vehicle was $12,500, okay? So, basically, we know that we are purchasing the vehicle, the new vehicle, on credit with the promise to pay it very soon. So if we are trading in the old vehicle, which was traded in at a value of $12,500, then that is going to reduce our obligation we have with Kern Motors, right? So if our obligation goes down with the Kern Motors, who are the other payables who were originally credited because they are a liability, now that we are trading in this vehicle worth $12,500, the obligation with them goes down. And if our obligation with them goes down, we have to debit it because the liability is decreasing. So make sure to be specific in exam, by the way. So debit other payables, specifically Kern Motors. I just don't have enough space here to write Motors. And that is $12,500. Then you're going to credit disposal of vehicle by $12,500. Now, very soon I'll be uploading a video for the ledger account that's involved with disposal of a non-current asset. So if you have any confusion, we hope to solve that within that video very soon, right? So disposal proceeds of $12,500, debit other payables, Kern Motors, because it's reducing our obligation with them for the new vehicle purchase, and then we're crediting disposal of vehicle by $12,500. All right, so 2 more lines here. So 9 entries in total so far for point number 4 already. Okay, now do not forget the profit or loss and disposal. So first of all, how do you find the profit or loss and disposal? You want to find the carrying amount or the economic benefits that are still left within the old vehicle just before disposal. How do you find the carrying amount? It's cost minus total depreciation. So the cost is $35,000, which we already understand by now that we have picked from the pre-adjustment trial balance. And then the total depreciation is $16,190. We got this by adding $15,200 from the pre-adjustment trial balance plus an additional $990 that we had calculated ourselves in point number 3, right? And altogether, that gave us $16,190. So once you subtract the total depreciation from the cost, the carrying amount we get is $80,810. And given that we sold the vehicle for $12,500, that means we have sold it for a loss, isn't it? Because it was worth $80,810 in terms of economic benefits that were still yet to be consumed, but we ended up getting rid of it for $12,500. So we have a loss. And the loss is simply the difference, which is $6,310. So every time you have a loss, you debit it because it's an expense. Every time you have a profit on disposal or any income or any sales or revenue, you credit it. So now that we have a loss and we know we are debiting it, so you debit loss on disposal of vehicle by 6,310, and then you credit disposal of vehicle for 6,310. So if you do all these 11 lines of entries that we have just done, 1, 2 here, and then we have done 3, 4 here, 5, 6, 7, 8, and then 9, 10, 11. So altogether 11 lines of entries. Pretty sure you're going to get full marks in the exam. All right. So that takes care of all the requirements for part A. Now, before we start part B, which is to prepare the current liability section of the balance sheet, let's look into the last point, which says the loan is repayable at a rate of $24,000 per annum. Okay, so the pre-adjustment trial balance includes loan of $120,000, obviously on the credit side because loan is a current liability. Loan is a liability, and by default, all liabilities are credited. And we know within the next 12 months, we will repay $24,000. So if $24,000 is due within 12 months, this fits the definition of a current liability, which is a present obligation that needs to be taken care of within the next 12 months. So this $24,000 is going to be shown within the current liability section of the balance sheet as something that is due very soon. So that's why when we are preparing part B, current liabilities, we started with the loan of $24,000 that we know is due in 12 months. Okay, then we have unearned sales revenue, which is also known as the prepaid sales revenue. So originally it was $3,500 in the pre-adjustment trial balance. And based on what we have done for additional information number 2, where we reduced the unearned sales revenue by $2,700. So we have to subtract $2,700 because our obligation with our customers have gone down because we have delivered $2,700 worth of value to our customers and therefore can recognize this as sales. So what's left behind is only $800 as the current liability or the unearned sales revenue for orders that are yet to be fulfilled. Then we have accounts payable, and that is $27,600, which is what we have just taken from the pre-adjustment trial balance. Creditors control of $27,600. And then we have other payables, which refers to other payables, specifically Kerr Motors, and that is $37,000. So how do we get $37,000? The original amount for the vehicle, including GST, was $49,500, if you recall. And then we traded in the old vehicle for $12,000. Is it $12,000 or $12,500? It's $12,500. So we traded in the old vehicle for $12,500. So $49,500 for the new vehicle minus $12,500 for the old vehicle. And that leaves us with $37,000 in present obligation that we have with Kerr Motors, right? So make sure to be specific here. Otherwise, whoever is marking your paper will deduct marks. And then I have included bank overdraft, and that is $5,500. So bank overdraft refers to you don't really have any money in the bank account. In fact, you owe the bank money. So your bank account is negative, right? So how do we know that? So you can see the cash at bank value here. It's not on the debit side like we normally expect because we know cash at bank is an asset. It is rather shown on the credit side, which refers to overdraft, that the business has withdrawn more funds from the bank account than they actually or originally made themselves. Okay, so this is an obligation and this needs to be taken care of very soon. So that is why we're reporting this within the current liabilities. So bank overdraft of $5,500. And then that's all for all the current liabilities we have. So all you have to do is add them up and you get $94,900 as the total for current liabilities that we have within the business. Okay. All right. So before we go to question C, let's see what else we can discuss. Okay. So I have 2 questions that I want to ask you. So let's start with the value for GST clearing. What do you think should be the value for the GST clearing after the adjustments have been made? Right. So if you check the pre-adjustment trial balance, you can see that GST clearing was $6,200, and that is on the debit side. So what does a GST clearing of $6,200 on the debit side really mean? Generally, in most cases, GST clearing is a liability account, and we expect the balance to be on the credit side. And the way this works is all the GST we have collected from our customers and all the GST that we have paid. So we do this offset, and then we find the final balance that we owe the ATO. Based on the pre-adjustment trial balance, GST clearing is $6,200 debit, which refers to the fact that at the moment, we can treat this as an asset because we have actually paid GST, more GST compared to what we have collected. And also, based on all the journals that we have done, based on the additional information, we had one more GST with regards to the purchase of the vehicle, and that was $4,500. So when we expect to pay this GST on the vehicle purchase, that is also going to reduce our obligation further, and we can treat this as an asset as well. So that is why if I was to find the final GST clearing balance after all the adjustments have been done, for this question specifically, it would be $6,200 plus $4,500, which refers to GST being paid in both cases. And whatever comes out to be the final value, which is $10,700 debit, is what we have at the moment after all the adjustments have been done at 30 April 2015. Okay, so just testing to make sure that you understand what's really happening. Then I also want to ask another question. So what is the cost of goods sold? Do you know how we can find the cost of goods sold? Right. So if you check the first line of this question, it says all stock is marked up by 50% on cost. Okay. Right. So first, let's look into the sales. So the sales was $420,000 for the pre-adjusted value, and then we added further $2,700 because you have just earned some sales revenue, right, based on the delivery of goods and services to your customers. So the total sales now, right, I apologize for that. So the total sales now is equal to $420,000 plus $2,700, right? So how much do we get for total sales? So 420,000 plus 2,700, and that is $422,700. Do we have any sales returns? You can check. We do not really have any sales returns, so this is the net sales we have so far. Now, given that we know the sales, and given that the markup is 50% on cost, okay, so how do we find the cost of goods sold? So let's just assume the cost of goods sold is known to be X. I'm just simplifying things here rather than writing cost of goods sold again and again. So we start with X, which is the cost of goods sold, and then you add 50% on top of this X, and that should give you the sales value. So this is what it simply means, a markup of 50%. So X plus 50% of X would give you 1.5X, and that should equal to the total sales value. And if you want to find the value of X using algebra, you divide the total sales with 1.5, and that comes out to be $281,800. All right, so $281,800 here, which is X, simply refers to the cost of goods sold. All right, so that's all. Now we can discuss the last question. Okay, so let's see what that is about. So outline 3 features of the accrual accounting system. Okay, so I'm going to have a discussion here. So when we think of the accrual basis accounting concept, it tells us to calculate profit based on all the revenues that have been earned and all the expenses that have been incurred by the business. Now, expenses are recognized as they're incurred, not necessarily when we pay for cash for all these expenses. Okay? Revenues are recognized as we have earned, not necessarily when cash is received. So revenues have to be earned. This basically means that you have to deliver the product or the service to the customer, and only then you can record this as a revenue that has been earned, and you could make the sale on credit and it doesn't necessarily have to be cash to be received on the spot for you to consider it to be as revenues earned. Right? Now, we are doing balancing adjustments in this case, in this question. And within the balancing adjustments that we perform, we're also doing some adjustments for revenues and expenses. As you have seen in the case of unearned sales revenue, which we have now earned, that increases the total revenue of the business. Then, for the purpose of expenses that we have incurred, you can start with depreciation, for instance. So depreciation is a non-cash expense that increases the expenses, and this helps us determine the accurate net profit because we are adjusting for revenues and expenses in this case. So also in most cases, all these balancing adjustments that we are doing, they end up affecting the current assets and the current liabilities of the business. What type of, not just current assets and current liabilities, it can also affect non-current assets. For example, the depreciation, the recording of depreciation increases the cumulative depreciation of the relevant non-current asset and would therefore decrease the value of the non-current asset in terms of carrying amount. But what about current assets and current liabilities? So when we do all these balancing adjustments, we can also reduce our current liabilities for unearned sales revenue, or we can have accrued expenses, let's say for wages. We could also have current assets, let's say for prepaid rent. We may have paid for rent in advance, or we may have accrued revenue or accrued income, which is like, for example, you have made an investment as a term deposit and you expect to earn interest as a business on that investment. So that refers to interest income or interest receivable, which also is known as accrued income, which is a current asset. And this is what you record in the books as well. So we do not really have all these situations involved within this question, but the main purpose of doing the accrual basis assumption for the balancing adjustment factor is to make sure that all these things have been taken care of, because if we don't, then we are not reporting the accurate current assets, current liabilities, and non-current assets. Lastly, if we ensure that all these things have been done properly, this helps us as a business to calculate the profit accurately and also prepare the balance sheet and any other financial statements, such as the cash flow statement, properly as well. And this also aids us in decision making. And that's how you get 3 out of 3. It's not going to be hard. So that's all for question 4 from this exam. Okay, so if you need any tutoring sessions, because exams are coming soon, make sure to check the link in the description to book a call with me and discuss your requirements. I'll see you in the next lesson. Goodbye.